I think it's a good thing for people to understand. So, going back to your example, right, where the purpose of the exchange is we've got a property that's appreciated in value. We're sitting on, if we sold it, we're sitting on some taxes we pay. We don't want to do that. So we buy replacement properties, kind of kick the tax can down the road, if you will. And then let's say that replacement property 10 years from now, you're like, hey, we've tapped out on this one. It's time to kind of find something better or get out of it. Well, if I get out of it altogether, I'm looking at paying this tax that I deferred 10 years ago. So yeah, one alternative is that people, they will kind of, we call swap until you drop. You continue doing exchanges until you
Right.
pass away. If basically, let's say extreme example, you did 5 exchanges, never bought up. It was just sold for the same amount your basis is carrying over from 10, 20, 30, 40 years ago. You're going to be sitting on if you sold that before you died, you'd be paying a hefty chunk in taxes. But the way that the tax law is written is if you pass away and your beneficiaries inherit that, the basis now goes, they call stepped up to fair market value. So if your basis was $50,000, but the property was worth $2 million when you passed away, then all of a sudden your beneficiary could sell for 2 million and not have to pay any income taxes. That can be a huge benefit in the right scenario where somebody has kind of done these multiple exchanges over their lifetime.
Hi, Adam Gower here, founder of gowercrowd.com and host of the real estate reality show at youtube.com/gowercrowd. Welcome to today's episode. My guests today are part of the tax or the series that we're doing on the tax benefits and implications associated with investing in commercial real estate. They are the husband-wife team of Amanda Han and Matt McFarland of Keystone CPA Inc. Now, Matt and Amanda are going to talk today about 1031 exchanges. It's a very interesting topic. There's lots of complications, as there is with anything at all, complexity with anything at all to do with the tax code. And Amanda and Matt unwrap that in some tremendous detail. What you're going to learn is how they work and how they can benefit you. You're also going to learn some easy to make and all too commonly made mistakes that investors stumble over when it comes to 1031 exchanges. You definitely want to stay until the end when Amanda and Matt talk about those mistakes. If you want to know more about them, go to the gowercrowd.com website, check out the podcast page there, and subscribe to our newsletter. It goes out every week. It's totally free, and you can always unsubscribe. And if you didn't already know, Gower Crowd builds crowdfunding platforms for real estate sponsors so you can raise more capital from more investors, even and actually, especially during downturns like we're having at the moment. All right, 1031 exchanges, part of the tax season series that we're running here, coming up right now. Amanda Han, Matt McFarland of Keystone CPA. Here they are. Amanda, Matt, what a pleasure to see you today. This is one of the rare occasions where we have two people on the show, so doubly intel. Really appreciate you joining me today. The topic, as I mentioned in this series on tax benefits of commercial real estate investors, both passive and active. So we're going to get into passive and professional, I should say, is 1031 exchanges. Let's talk about exactly that topic. Why don't we start at the very, very top? And just tell me, what is a 1031 exchange? I'm going to jump in with some follow-up questions.
Great. Well, thanks again for having us, Adam. Appreciate it. Looking forward to this. Yeah, 1031 exchange, a big picture. It's one of those tax code strategies allows you to sell an existing property, buy replacement property or properties, and do it in such a way that you don't have to pay taxes right now on the property you just sold. That's kind of a 30,000-foot level. If people follow all the rules, which there are plenty of them, and I'm sure we'll dive into it, it can be a great way to continue to expand somebody's portfolio without having that tax drag to kind of slow you down.
Yeah, I think if you think back to when we were kids and we played the game of Monopoly, where you buy a couple of greenhouses and you trade up to a red hotel. So it's that same exact concept. And then the added benefit is not paying taxes in the process.
Right, but it's a deferral of taxes, isn't it? It's not an avoidance completely of taxes. We're deferring them. So why don't we start at the very? I've said this, so I keep saying it. Start at the top. We keep starting at the top for each subheading. We'll start at the top. What are the rules for a 1031 exchange?
Yeah, there's a couple and with respect to the rules for 1031 exchange, there's a couple of monetary rules, there's a couple of time requirements. Speaking of the monetary rules, there's two main ones. The purchase price of the replacement properties has to equal or exceed the sales price of your relinquished properties. And then also the equity that you're putting into your new properties has to equal or exceed the equity that you're taking out of your relinquished properties. Those are the two main monetary rules.
Yeah, I think if we use an example, you buy, let's say you have a single family home that you are now selling for $500,000 and you wanted to do a 1031 exchange. Well, then you need to buy a new piece of property for at least $500,000 or more in purchase price. And then if you do that, you'll be able to meet that monetary requirement in terms of purchase price.
Right, and you also have to have the same amount of debt, don't you? There's the proportion of equity and debt. Just talk to me about that briefly.
Yeah, it's actually a common misconception. So technically speaking, you have to have the same amount of equity that you're rolling into the new property. You could sell a property for $500,000 all cash, have no debt on it, and go buy a $3 million property that has $2.5 million of debt. Or you could buy a $3 million property all cash without any debt on the replacement property. So the debt, obviously an interplay with the equity, but technically speaking, you got to roll the equity into the new property.
And there are some timing rules. So please just highlight what are the timing rules involved, please.
Yeah, I mean, the timing rules, the two main ones basically people need to know about is once you sell your existing property, you have 45 days to identify potential replacement properties in writing. There's a process you go through with your intermediary, and that's 45 calendar days. So it doesn't matter if, you got to include weekend days and all that good stuff, right? Holidays. And then in addition to the 45-day identification window, you have 180 days from the sale date to actually close on the replacement property or properties. And again, that's on a calendar day, and that 180 days does include the 45-day identification window.
And you can also split into multiple properties, can't you? How does that work?
Yeah, so in a 1031 exchange scenario, it's not uncommon where you would sell a single family home and trade up into multiple properties. So you might buy a duplex as a replacement, or you might just buy two other single family homes. So it's very flexible in terms of what you're selling and what you're replacing. And conversely, we see this as well, where maybe you are selling two single family properties around the same time. Those could be combined into one 1031 exchange where your replacement could be one large apartment building.
What is the actual process for doing a 1031? How do you do it in a way that actually gets you the results that you want?
I think if we maybe to take a step back and start at the top, like you say, the first question I think we want to look at as investors is whether we should do a 1031 exchange. We always talk about how amazing 1031 exchange is because you can defer taxes, but the reality is the 1031 exchange is not necessary for everyone. So I think the first step is to figure out what is your taxable gain. Right? I'm selling a property. What is my taxable gain? If you've done things right, hopefully you have a big gain. But if this wasn't a really good deal after all, maybe you don't have a huge gain when you're selling a property. So first step, do I have a gain? How much is it? And then the second step is, what do I currently have to offset that gain? So in other words, there are investors who maybe already have losses from other rental properties or losses from previous years. And to the extent I already have losses, I can offset the gain, then maybe I don't really need a 1031 exchange. But let's say that you've calculated your gain, you looked at your other offset opportunities, and you still are looking at a large gain. Now we look at the first step of a 1031.
Yeah, and so that's where you want to work with your team of advisors one of the people on your team that you need to get involved is a qualified intermediary or an exchange accommodator, kind of those are same terminology, but that's really important because you have to get them involved before you've even started the sales process of your existing property. So a lot of times I think a misconception is people, hey, I've got my property, I go and sell it, I've got my check, okay, I'm ready to do 1031 exchange. And unfortunately, that's totally blown at that point in time, so you really need to get that intermediary involved ahead of time. And they're going to kind of walk you through the whole process. They're going to help you with the paperwork, the identification, how to sell the property. They're going to hold on to your money once it closes. And then you're going to find your replacement property. They're basically the middleman, right? And, if you follow the rules, and a good intermediary should be walking you through this process and kind of helping you avoid stepping on the landmines, if you will. Along with, your CPA, your tax advisor, they should be working alongside with you as well.
Right. So, and the point you're making is that you cannot take possession of the money from the sale. That's what you need, an intermediary that somehow escrows it. I'm not sure if that's the right.
Exactly. Yeah, I know that's a big picture for sure. Yeah, you can't even, some people, well, I got a check, I never deposited. It's like, it doesn't matter. It's you've got possession of that check. Unfortunately, that's what the IRS considers a blown exchange at that point in time.
Right. That's the technical term for that is you are SOL, right?
Yes.
If that's what you do. All right. So now, Amanda, you actually used a very important term there. Now, I want to caution you on something. Please assume that anybody watching this episode doesn't know as much as you know. So let's start at a 101 level and then dive deep. So use the term losses, the losses. So what I think you're talking about is depreciation. I might be wrong. So can you let's really get into this in some depth here. So what do you mean when you talk about losses, and what should you be looking at when you do a 1031, and how can you lose the benefit of losses, i.e. depreciation, that you might be carrying over somehow?
Yeah, that's a really interesting question. When we talk about investing in real estate, oftentimes we talk about tax losses. And so people might be confused on, why am I going to invest in something and lose money, right? So it's important to understand that as a real estate investor, if we're talking about rental real estate, whether it's single family, commercial properties, one of the benefits is that the IRS allows us to take depreciation on the property. So basically they say, this property, this building that you own, it's going to have wear and tear over time. And as a result, I'm going to allow you to take a paper write-off, what we call depreciation, on that purchase price year after year. So in a normal scenario, if I have a building, let's have an apartment building, not only do I get to write off mortgage interest, property taxes, management fees, insurance, just the regular stuff, I also get to take a paper write-off of depreciation that's calculated every year. Mm-hmm. And if you're being strategic about how you calculate depreciation, there are some amazing ways that you can create very large paper losses initially in the first couple years of owning a property. So that's where we see you have rental income, after expenses, still really good cash flow, but once we also deduct the paper losses, we end up with a tax loss. So this is where you hear people talk about, losses. We're really talking about a strategically created tax loss, not actually losing money on a deal.
Yes, right. So I'm going to try and maybe we can use an actual case study to understand this a little bit. But so if I buy and I actually want to think about some bigger numbers. So most of the people that we communicate with are high net worth accredited investors who have either got properties of their own that are maybe fairly sizable, not necessarily single family homes. They might be larger properties that they're going to transfer or that they want to sell. They might want to move up into a syndication, for example. So we'll get into that in a second. So the numbers look a little bit different. But here's a key thing that I've recently learned, and this is what I wanted to ask you about. Let's say you do a 1031 exchange. So we've got two properties. And also let's use the proper terms as well. So we've got two properties, one that we are selling for a profit. Let's say it's $1 million profit, whatever, right? $1 million profit. And we are buying and we have some depreciation that is carrying over from that sale. and we buy a property that's 10 million, right? For argument's sake. The key to understand this is that when you do the exchange, the depreciation, and then let's say you do a cost seg study on the upleg, and you're able to take some bigger depreciation because you bought something much bigger. The issue is that the depreciation that you carry over from the sale actually carries over to the upleg as well, doesn't it? It's the same depreciation. It just carries over. So let's say you do buy let's say you buy a $2 million property. You've got $500,000 of losses that you're carrying forwards to the upleg. That stays with the new acquisition. And the only benefit of a cost seg study is anything in addition to that. I probably explained that rather clumsily, but can you try and unravel that a little bit for me? You know where I'm going with that, don't you?
Yeah, no, big picture, the understanding is correct. So there's a couple things, you mentioned a couple things, right? So if you take in depreciation on your existing property, you have a tax basis in the property. That's, your cost minus the depreciation. If you do an exchange, that generally does roll over into the new property because you're not paying tax on it right now. But if you do have an upleg, so you're buying, in our example, I think you said you bought $9 million more than the existing property, you're going to have an extra $9 million of basis you could potentially depreciate. Generally, that basis from the previous property does carry over. There's ways to kind of reset it, restart it, if you will, if that in the situations it makes sense. But generally speaking, that does happen. Yeah, I think that's.
And I think in your scenario, you mentioned there were accumulated losses, right? So let's say this property just didn't perform well, or, for whatever reason, there were accumulated losses. Those do carry forward as well because it's a 1031 exchange. But I think that will go back to what I was saying as step one, what is our gain? So if I have $1 million of gain and I have $800,000 of losses, then the losses offset the gain. So I really only have $200,000 of gain, right? After factoring in my losses, then that's where the strategy analysis comes in is, does it make sense for me to do a 1031 exchange to defer this $200,000 of gain, or do I just sell it and then I'm going to buy my new replacement property anyway in a regular transaction? Right?
But you're talking about actual losses versus paper losses in that case, right?
Yes, I'm talking about just net loss.
Yeah, real losses. Like you invested $1 million, you sold for 800,000.
So I'm talking about cumulative losses that are carrying forward for a property.
So it could be related to depreciation. Maybe you've taken depreciation of property, has created a loss. Somebody wasn't able to deduct it because their income was too high or various reasons. So then maybe they've got $500,000 of net losses accumulated from that property, from other properties. If you're going to go and sell for $1 million gain, in a lot of situations, you can use those losses to offset the gain so that it reduces the tax impact on the sale. Yeah,
especially for high income, high net worth individuals, we see this profile most frequently when they are not real estate professional. So if you're not a real estate professional and your spouse is not a real estate professional, oftentimes those losses that are created on the tax side are passive losses, and they're passive. They keep carrying forward until you sell a property outside of a 1031 exchange.
Outside of a 1031, but inside a 1031, that it only carries forwards within the
it just gets attached to replacement property, so you continue carrying those losses forward if you did a 1031 exchange.
Now, what if you have, so I actually want to use an actual case study, if you don't mind, because it helps me to kind of rationalize the questions and think through this, but it does apply to other people as well. So, for example, one of my properties is a property that I've owned for 20 years. It has a basis of 400,000. There's debt on it of 500,000, and believe it or not, it's a duplex. It's worth over $2 million today because I'm in California and I've owned it for 20 years. So these things are actually possible in California. So in that case, if I were to sell and do a 1031, that 400 of basis, that is what's going to carry forwards, right? So if and that's a key thing to understand. That is what carries forwards. So I have to buy something that is, in order to benefit from accelerated depreciation or depreciation from the upleg, I have to buy something that is bigger in order to be able to capture more depreciation and more tax losses on the upleg, correct? It has to be bigger.
Yeah, if you're a replacement property, you sell this one for 2 million, you buy a replacement for 2 million. There is no upleg, right? So in that example, your carryover basis is 400. You continue depreciating as you have been.
Right.
But if you get an upleg, that's where you can potentially, do extra depreciation on the upleg.
So let's say you sold this one for 2 million, right? That's the fair market value. You buy something for 3 million. Now your upleg is 1 million. So you get carryover basis of 400,000 plus upleg of $1 million. Now you have 1.4 million of basis.
Right. So to kind of really dumb this down for people like me who don't really understand, if I did sell a 2 million and bought a 2 million, I cannot suddenly take accelerated depreciation on the new property. I'm carrying over the depreciation conditions of the sale property. That's the point I'm getting to, right?
Right.
I can't suddenly buy something. Let's say I buy a car wash, for argument's sake. I can't suddenly say, oh, great, I got 2 million. Now I can take 2 million if it was 100% in the first year, which has changed. But let's just assume 100% accelerated depreciation. I cannot now suddenly say, I've sold this one here with 400 of basis. I bought a $2 million property, and now I've got $2 million of depreciation in the first year because I bought a new property. Doesn't work like that, does it?
No, that's why that's the benefit of the exchange is you're not paying tax on that $400,000 your gain right now, so you get carryover basis.
So you have to buy something bigger to get that additional depreciation benefit.
If that's the person's goal, yes.
Mm-hmm.
Well, what other goals might you have?
Well, for some people, the goal is just to defer the tax, right? So for you, it might be that I own this property, I want to sell it for 2 million and not have to pay any taxes on my gain. And that's it, right? That's the end of my goal. Then you buy something for 2 million. But if you're someone in growth mode and you want more tax benefits, then yes, you're trading up. And that's why we have an up leg in that other example.
Or your $2 million property is you feel like the market's tapped out, it's not performing very well. You can buy a $2 million property somewhere else that's going to perform a lot better. You're changing apples to apples, but you're going to get a better cash on cash return.
Maybe a better yield, forward. Exactly.
Right.
Coming from that. So you've used this term upleg. So for somebody that does buy something of equal value, is there a different term? Is that not called an upleg? Is that called an equal leg? Somehow, is there another term?
I don't know. That's a good question. I'm not aware of another term for that other than just buying. I don't know.
I think when we say upleg, we just mean like the replacement property.
Yeah, that's probably used interchangeably with replacement property, but
yeah, but we say buy up. So I think it's kind of confusing. Upleg is just a replacement, and if you're buying up in the upleg, just to confuse people more, it's an upleg.
Yeah,
it means you're buying something for more than you're selling for. That's the point.
Yeah.
Yes.
Right. And then there's another term of art that we shouldn't miss, and that is the term like kind. By the way, the first time I got involved in real estate in the mid 1980s, I don't normally like to admit that, it just really betrays my age. But one of the first deals we did, interestingly, was we had an investor who was selling a property and wanted to do a 1031 into a syndication. And the term of art was this concept of a like-kind exchange. What does like-kind mean exactly?
Yeah, I think in layman's terms, like-kind is that you're selling an investment property for an investment property, or again, investment properties. You could be selling an apartment building and buying a strip mall. You could sell an apartment building and buy a car wash, as long as it's real estate, right? You could buy, selling single family houses and buying an apartment. So it's really just got to be, kind of easy way to think about it, rental property for rental property. And there's a lot of nuances, obviously, but, to your point, one of the things that's not per se like kind is selling existing real estate and buying a partnership interest in a syndication. That even though the syndication is going to own real estate, you in that example are buying an LLC interest and not buying the underlying real estate because you don't own title to it. So that's kind of one of those nuances.
We see a lot of workarounds for that, especially For syndications, you know, we do have clients who, if the dollar amount is significant enough, they will structure the syndications slightly different to be able to take on 1031 exchange money. But typically, like Matt said, the difference is you get ownership in that property, but you're not a member of their LLC.
Yeah, so I do want to drill down on that because that is a key topic that I want to explore in terms of 1031 discussion. Just to be clear, though, jump back briefly. You can't say the key term in a like kind exchange that you used, I think, was rental property. In other words, I can't 1031 the home I live in, can I?
Right. Yeah. You're not doing a 1031 exchange on your primary residence or second home that you never rented out. This is, yeah, easiest way to think about it is you're selling rental property and buying more rental properties, basically.
I mean, not to complicate things, but there are times when, let's say you had your primary home and you turn it into a rental property. So if it is a rental at the time of the sale, it is possibly eligible for a 1031 exchange.
Yes. Okay. That's a good question. So just drilling down on it, going down that rabbit hole a little bit further. So you've got a primary residence, you buy another one, and you want to, and there's all kinds of I think it's 250,000 if you've of non-taxable gain if you've lived in it for what, 3 years of the last 5 or 2 of the last 5. I mean, let's not go down that. But how long, if you decided you've got more gain than you can than you want to pay tax on in your primary residence when you sell it in order to buy another home, just again down this rabbit hole, how long do you actually have to rent it out for not to trigger an IRS audit? Can I rent it out for the weekend and say, okay, I'm selling it?
That's a great question. You know, I think there's not a specific set of laws that explain exactly how many days. So there's nothing that says, 6 months is fine, 3 months is not fine. The IRS will always go back to the concept of intent. So what is your intent? Is your intent to keep it as a rental? So, if I rent it on Airbnb for 3 days and I do a 1031 exchange, probably not enough to show my intent of keeping as a rental. So it comes down to facts and circumstances and what you can prove in terms of intent. And so that's where the benefit of tax planning, right, can go a really long way. But generally speaking, the longer you keep it as a rental, the better it is to solidify what that intent is.
Yeah, to show real intent to do it. All right, so now let's talk about exchanging, and you moved into this direction, so let's get back to it. The idea that you sell a property for which you have title, let's call it, let's say in my case, this one asset that I have, which is a duplex, and you sell it, but you want to 1031 into a syndication. How do you do that? It's called a tick, doesn't it? But can you just kind of drill down on that? What does that involve? Because we do see that a lot. With syndicators encouraging people to do 1031s into their syndications. Can you explain how that works?
Yeah, I think paint like 2 pictures, right? The first picture is that the situation doesn't work, right? It's the LLC, the syndication LLC is going to buy the real estate and they're raising funds from investors, and you've sold your property for, let's say $2 million all cash. You've got $2 million you're going to invest in the syndication. You are now an LLC member. You own, whatever 3.375% of the LLC. That one's the one that doesn't work in the 1031 world. The way they kind of tweak it to help people who are, high net worth individuals who are coming to the table with a lot of money and, entice them to invest, is that now owning this new property, there'll be 2 owners. There'll be the LLC that was originally there, and there'll be you as one of the other members. So both of you are owning title to the real estate. You might be owning, in my example, 3% of the title. The LLC might be owning 90 or 7%. But to Amanda's point, you're not a member in the LLC. You are a tenants in common owner of this 3% of this property. Because you are technically entitled, that is allowed for 1031 exchange purposes. And we'll see that again a little bit. We'll see that more and more nowadays with higher net worth individuals with a lot of money, because the syndicators are wanting to kind of appeal to this market and, open the door for additional cash, obviously.
How complicated is it for a syndicator to accommodate a 1031 by setting up a TIC, a tenant in common structure?
I think that's a great question. I mean, I think it's a better question for a syndicator, but I mean, I have my opinions on the matter, but
Well, what
Yeah,
are
I
your
know
opinions? Yeah.
legally, right? Yeah,
Huh?
I mean, legally, they have to structure it differently because it's outside of the syndication. So
Mhm.
there's legal costs associated with it. Accounting wise, you have to split it out. It's not part of the fund K1. It's going to be part of another set of tax returns that TIC owner is responsible for. So there's certainly additional complexity on the accounting side. Yeah, and also tax return wise, it's going to be treated differently. And that's the reason why, like Matt said, you see the sponsors who are only offering this if you're investing a minimum dollar amount. I'm only, hey, if you got a 1031, I'll take your money if you're doing more than $1 million or 1.5 million or whatever it is. And it's not because they're being discriminatory, it's because there is that added level of complexity and cost for them to help accommodate. But what's really interesting is that there's a concept called the lazy 1031 exchange.
Mm.
And so the lazy 1031 exchange works fairly well for people who maybe don't have that million or 2 million to exchange into, but they still want to sell their own property, sell my own apartment, and 1031 into a larger syndication that's A-class apartment.
Mhm.
And so that's done when you, in the most simplistic form, it's basically selling a property in a regular sale and then taking your cash to reinvest in a syndication in the same year of that sale. So basically, if I sold my own apartment, I'm investing in your syndication. Your syndication is going to give me a huge tax write-off from depreciation, cost segregation. I can use that to offset the gain of my property, even though it's outside of a 1031 exchange.
I see. That's interesting. So it's not really a 1031. It
Yeah,
isn't.
we call it a lazy 1031 because
Right.
it's not an actual 1031. It's basically a strategy to create an offset in the year that you have
For
the
the
capital
gain.
gains.
Right. And that depends on accelerated depreciation of the purchase of whatever it is you're investing in. That
Right.
passive.
Yeah, I mean, there's a couple benefits to it. Again, this is beneficial for those investors who don't have over $1 million to place into a deal. So it's a lower barrier of entry because you're just like any other investor. You're just investing in their deal. From the sponsor's perspective, it's like any other investment. So you don't have to set up special entities. You don't have additional legal work or accounting work. They're like any other investor. So to make that effective, the key is having the right communication between the sponsor team and the investor. So they know, here's how much, if you invest with me, here's how much depreciation you can expect to get. And then hopefully that goes a long way to help offset whatever property they are selling or have sold.
Yes. Right. So again, just to be clear, you use the term 3%. You calculated it very fast in your brain. My mother actually always wanted me to do. Said my uncle Archie always could calculate, 2 and 3 number multiples like in his head and do them upside down, all kinds of things. He was a crazy guy. These days we use Excel and calculators, but today we've got Matt, so we don't need to worry about that.
Right.
But let's just say, for argument's sake, that you were to exchange into a syndication that gives you an exact equal proportion to the asset that you're buying. You would end up, let's say, in this particular asset I've got, I'd say there was $1.5 million of gain that I was trying to shield. If I then, if the pari passu proportion of the upleg was exactly equal to that 1.5 million, I would get no additional depreciation benefits. I would just carry over what comes from the original. Correct?
Correct.
So that means that somebody in a similar situation that I am has to look for some kind of outsized proportion of whatever they're investing in order to be able to capture additional depreciation benefits. Is that correct?
Yeah, I think if you're going, again, there's 2 different possible goals. If your goal is just to defer the tax, you sell for $1 million, you buy for $1 million, you reach your goal.
You're done.
If my goal is to defer tax and get a bunch of new depreciation,
yes,
then that's selling for $2 million and replacing for more than $2 million. So 3 million, 4 million, 5 million, the higher, the more the additional you're buying up, the more depreciation you'll potentially get.
So to just to drill down on that then. So let's say somebody's got $1 million that they're going to exchange into a syndication. The syndication is raising 10 million of equity. And correct me if I'm missing some stuff here. You talked about debt as well. I actually thought debt was important, but let's say it's 10 million of equity. And the syndication said you will get 10% in your tick structure. You're going to get 10% of the ownership. That's a wash, isn't it? I would have to say to the, as far as additional depreciation benefits, I would have to negotiate something with the sponsor who is selling me this syndication piece to get, let's say, 15%. I'm going to bring $1 million in, but I want a disproportional amount of the ownership in order to get more depreciation or an extra layer of depreciation benefits. Am I understanding that right? Am I explaining it right?
Yeah, I know. I understand the question. That does bring loads of complexity to it, because those are situations that can backfire from a tax planning perspective, where people are expecting to get extra depreciation, or, so earlier I was mentioning the whole tick structure. It comes with its complexities, and one of those is where the numbers, there's no easy way to explain it, but
the inability to do special allocations of what you're talking about.
Yeah.
Where my money is only representative of 10% ownership, but I'm actually getting 15% ownership. That is not possible in a tick structure.
yeah, you're bringing $1 million to the table. Your $1 million represents $1 million. And so, if you're supposed to be 10% owner, you can't be trying to get depreciation on 15%. It doesn't work like that in tick structures, unfortunately.
You can only do that when you're part of an entity, right? So in a syndication, you can have different allocations. Class A gets this, Class B gets this, waterfalls. That's all possible because of that LLC at the top. And so that's the piece you cannot get when you're in a tick ownership. Like Matt said, it's complex, but it's also simple at the same time. It's just straightforward. It's based on ownership, based on funding. And this is an area we see a lot of people get into trouble because they didn't understand that. So they get into this joint ventures with other people thinking like, well, this is what we agreed to. But at tax time, the joint venture tenants in common, it must go to the ownership based on money.
Or another great way to look at it is like your $1 million, maybe you're putting in your $1 million, but that really only represents, I don't know. You're putting the $1 million because you think that's what you need to put in, but it really only represents 5% ownership or something, and that can trigger gain on your exchange without even realizing it.
Yeah, because 5% of that.
We've seen that happen before too, where it's, well, I gave you all my money, I put all my money back into the new deal, but it's like, yeah, but based on your ownership percentage, you only had to put in 500,000, so now you got tax on the other 50%.
Right. So it's disproportional in the other direction.
Yeah. It's kind of where the other direction, right?
So one way that you could do it is you could say, so you've got somebody, for argument's sake, raising 10 million, and you've got $1 million of gain. You could say, look, I'm bringing $1 million. That's pari passu, right? The tick is not going to allow anything else. So I've got no. And by the way, what I'm trying to get to here is additional depreciation benefits, right, from the exchange. So I'm bringing 10% of the deal. Give me, in return for that, 10% of the GP ownership. If I got 10% of the GP ownership, that would allow me to capture some additional depreciation benefits, wouldn't it? Or would it?
If you are outside of your exchange, if you're getting an ownership interest in the LLC and another way for being a sponsor or something like that, you might be able to get depreciation benefits from that if you are sharing and you're signing personal guarantees, or you're sharing in some of the loans on the property if there were loans. So there's ways to do that for sure outside of the exchange.
Yeah, I think what you're describing is just something completely outside. So that's just like any other structure.
Or obviously there's nothing to prevent somebody from putting in their $1 million as the, whatever percent owner in the tick, and then separately in the LLC put in another $500,000 of their own money to be an investor in the LLC with their own cash. There's nothing that prevents that either. Because that would give you the ability to take
then you would get the depreciation.
Right.
All right. So I hope this is not getting too technical. But
We could talk about this all day long. I just,
All right, good.
This is the fun stuff for us. And I think you can see just in our short discussion here why tax planning is so important, right? It's not just why I heard this on a podcast, I'm going to just go ahead and implement because there's so many intricacies, pitfalls that we want to watch out for. But you can also see there's so many opportunities too, right? Different ways of, creatively structuring it so you can save the most amount of tax and also get additional depreciation if that's your appetite for growth.
Well, look, Amanda, this is exactly what you and I were talking about when we first met, was the need to consult with somebody who knows what they're doing before you actually make a decision to do something, because you can make mistakes. In fact, we'll come back to mistakes that people make in a minute. I've got another technical question for you. Again, I hope you don't mind. I'm going to add the extra layer now of an opportunity zone. Boom, opportunity zone. So again, I'm going to try and describe as I understand it. An opportunity zone today, and we are early to 2024, means that you can you could sell a property, buy directly into an opportunity zone, defer the payment of the capital gains, I think as it stands today, until 2026. And then after 10 years, any additional gain you get is tax-free, right? Or at least not tax-free. There's a step-up basis. And so it ends up being capital gains tax-free. Right. In that case, I still have to pay tax at the end of 2026 for the gain. I'm just delaying the obligation for when I pay tax. It's not a 1031. On the sale of the property today. Can I do a 1031 exchange into an opportunity zone deal that would both eliminate that need to pay tax at the end of 2026 as the laws are now, and allow me tax-free gain at the end of 10 years?
I think you'd have to go through the math. I mean, there may be a way to utilize both strategies. But yeah, with an opportunity zone, I mean, you mentioned selling property. Technically speaking, somebody could sell stocks too. All we're trying to do,
right.
They're allowing you to defer paying taxes on capital gains income. But yeah, there's two main benefits. You get the deferral of tax until 2026, so it's not as long a deferral as it would have been back in 2019 or 18 whenever they came up with this. But the other carrot they're dangling is the replacement property you're investing into. If you hold that for 10 years, the appreciation on that property can become totally tax-free,
right,
if and when you sell it after 10 years. So that, the upside of that depends on the numbers. Obviously, if you're only expecting to go up $50,000, it may not be worth going through all the hassle. But yeah, to your initial question, there might be a way to utilize both a 1031 and an opportunity zone. We haven't seen it in practice.
Yeah,
but
I've not seen a 1031 exchange into an opportunity zone, but we've seen a combo 1031 an opportunity zone. So an example is somebody who sells a property and they planned to do a 1031 exchange. However, because they couldn't find the right property, or they didn't buy the right amount, it resulted later in a capital gain from a failed or partially failed 1031. At that point, you can no longer 1031 because we failed it. And so opportunity zone is sort of like a saving grace to say, well, now let's put that money into an opportunity zone to get the deferral and the tax-free growth. So we've certainly seen that, but it's a slightly different than what you described, which is 1031 into an O zone.
Yeah, because the idea of investing in an opportunity, I invested in a little startup some years ago. I was expecting for years to get a tax loss, like a total write-off on the damn thing. But suddenly I get an email that says, they sold the company for $250 million and you 6x'd your investment. Oh my God, that's like a bonus. It's my birthday kind of thing. And I transferred I purchased into a opportunity zone. And it was then that I thought that going into an OZ eliminated in the same way as a 1031 capital gains tax, but it doesn't. It just defers it slightly. The big benefit is this 10-year tail, right? Anything that grows, then at the end of that 10-year tail, then you get no tax. So that was why I was interested. If doing a 1031 is not kind of almost wasting one aspect of the tax code to do a 1031 into an opportunity zone, it seems to me to make sense, because then at the end of 26, you don't have to write a big check for something that you sold 2, 3, 4, 5 years earlier.
Right.
Right. This idea of 1031ing eternally until we meet our maker. This is the step-up basis idea when you die. So can you just explain that and why that's important, a concept to understand, that a 1031 doesn't avoid tax, it just defers it. So that nuance, if you would, please.
Yeah, I mean, I think it's a good thing for people to understand. So, going back to an example, right, where the purpose of the exchange is we've got a property that's appreciated in value. We're sitting on, if we sold it, we're sitting on some taxes we would pay. We don't want to do that. So we buy replacement properties, kind of kick the tax can down the road, if you will. And then let's say that replacement property 10 years from now, you're like, hey, we've tapped out on this one. It's time to kind of find something better or get out of it. Well, if I get out of it altogether, I'm looking at paying this tax that I deferred 10 years ago. So yeah, one alternative is that people, they will kind of, we call swap until you drop. You continue doing exchanges until you pass away. If you basically, let's say extreme example, you did 5 exchanges, never bought up. It was just sold for the same amount your basis is carrying over from 10, 20, 30, 40 years ago. You're going to be sitting on if you sold that before you died, you'd be paying a hefty chunk in taxes. But the way that the tax law is written is if you pass away and your beneficiaries inherit that, the basis now goes, they call stepped up to fair market value. So if your basis was $50,000, but the property was worth $2 million when you passed away, then all of a sudden your beneficiary could sell for $2 million and not have to pay any income taxes. That can be a huge benefit in the right scenario where somebody has kind of done these multiple exchanges over their lifetime.
Again, this is something that's really important to talk to a tax advisor like you guys to understand how this works, because it really does speak to planning. This is the key thing with tax. It's not something you can do on December 31st. You got to plan ahead to get the full benefits, right?
Yeah, I think a mistake we see in this area quite a bit is, especially as people age, they start to add their kids on title to real estate. We see this all the time. Actually, you'll see it with like some family members too who do it. And just kind of haphazardly say, oh, I'm older, I want my kids to help, be
able to make decisions.
Yeah. Or something. Yeah, like if something happens to me, I want them to make decisions. We go ahead and start adding them to title. The issue with that is once they're on title, that portion of it will no longer get 1031 exchange because you've gifted them ownership.
Get stepped up basis.
Sorry, yes. Step up basis, because it's no longer part of your estate. And so the better way to do it is to add them as trustees in your trust, so they can make decisions but not necessarily have ownership. And this is when we see, unfortunately, time and time again, people making that mistake.
Really, they add their kids or their heirs to title on property.
Yeah, and people usually tend to do this when they're when they're retiring, when they feel like they're kind of exiting mentally from real estate. But the downside is at that time you're closer to death, right? For lack of a better way to describe it. And so you're like almost there to get that step up basis, but making a mistake could be pretty costly.
And since I'm the math calculator, if we put numbers to it, right? So if your basis was 50 grand and you put them on title for 10%, they're taking over $5,000 of that basis. So if and when the property sells for $2 million, their share is 200,000. They're now paying income taxes on $195,000 that they wouldn't have had to pay taxes on if they just inherited the property after you passed away. So that's the pro and con.
Gosh, I never thought of that, actually. And I cannot believe the time. You guys are absolutely amazing. We've been talking for a long time on this topic. Thank you so much. And in fact, you've dovetailed into what I'm actually going to ask is the last question, What other big mistakes have you seen or do you see people making with 1031 exchange? This is a fascinating one, like giving title, putting your kids on title or whatever.
God, how much time do we have?
Yeah.
Where do we start?
As much as you want. Give me like the big ones that you see most frequently and the most costly.
Yeah, I think the one that we just mentioned is one of the most costly. Not only is it common, but it's also very costly because we're talking about generational taxes, right? If we kept it till death, we give it to the beneficiaries, not only are we not paying taxes, but they get step-up basis. So if they kept the properties, they'll get depreciation based on the new basis. So
Oh,
that's
wow,
pretty
really?
amazing.
They also get
So it's a
depreciation.
generational strategy. I think we see a lot with titling probably.
Yeah, I mean, I think, that example we talked about earlier, that with doing the tick, and where, you need to put in $1 million of your exchange, but really your 5% ownership is only going to be $500,000. We've seen that come back to bite people a few times because they go into it without having that proactive conversation with their team of advisors, thinking they've kind of figured out all the math, and they go and, come talk to their CPA 6 months later at tax time. It's like, hey, you got a problem here. And they didn't know about it because they didn't have that conversation. So that is one big one. But obviously, not getting an intermediary involved early enough. I've seen that come back to bite people too.
I think another big one is titling. One of the rules of 1031 exchange is the seller and buyer must be the same taxpayer. And so what I mean by that is if this Main Street property was reported on my LLC tax return, let's call it Main Street LLC. When I sell, my replacement property needs to also be reported on the Main Street LLC tax return. That part of it cannot change. So what happens sometimes, people sell in Main Street LLC, and then for whatever reason, loans or whatever, they buy the property, the replacement in their personal name. Now that's on their personal tax return, and that could create an issue as well. I'm simplifying it a little bit, but just have an understanding that the same taxpayer, whether it's an entity, it's a trust, whatever it is, the taxpayers need to be the same on the sale and the buy side too.
This is really complicated. Just jumping back, and I did say last question, I was just going to make a point. Jumping back to this idea that you might invest, $1 million, but thinking it was 10% pari passu, but it's actually only 5%. The only way to really figure that out is by looking at the offering documents of the syndication, and you can look at those. I mean, I've studied those until I'm blue in the face. Some of them are so long. I like to count the number of words in those things. I'm a little obsessed. You put them into a Word doc. Some of them are so long, they're like the length of a fairly long novel, 80 to 100,000 words. I mean, seriously, ridiculously long. And there are huge sections of those dedicated to tax treatment. I never read those sections because they might as well be written in a foreign language. It is beyond comprehension. Right. So you really do have to work with a specialist to get this right, don't you?
Yeah, absolutely. I think that, especially when you're doing anything that, involves real estate and taxes, it's always good to kind of have a tax advisor on your team because, you don't need to be a CPA yourself, but you need to be able to communicate what's happening in your life and do it in a, before the things happen, because that's where we can help people the most is, let's talk to you before the stuff happened, not after the fact or on April 14th or what have you, right?
Right.
Yeah, and I think the larger the deal, the more important it is. If you're a syndicator, you must have a CPA who's well-versed in syndications. If you're a high net worth individual or high income individual, the presumption is you're paying higher taxes. So it's important to work with an advisor who understands real estate and strategies for high net worth individuals too.
Perfect to tee up my last question. So I like to say my last question several times, but this really is it. What is, of course it isn't, but what is your specialty, right? So Amanda, you and I had a conversation. You guys have a tax planning program. It sounds very interesting, but what do you do specifically, and who is your ideal, like who would benefit the most, or what would be characteristics of somebody who would benefit the most coming to you and working with you guys?
Our firm is called Keystone CPA, and we specialize in working with real estate investors nationwide, specifically on how to use real estate to save on taxes. And so a lot of people ask like, well, how much money do I have to make to be a client? Like, who's your ideal client in terms of money or income? And surprisingly, it's actually not that. We have clients who make, $60,000 a year to people who make millions of dollars a year. So the ideal client is really someone who is looking to build wealth through real estate. It's someone who is looking to go with acquisitions. They're wanting to use real estate as not just a wealth building vehicle, but also a way to reduce taxes. So, we have clients that are like, just starting out, but very ambitious and trying to grow a couple properties per year, or people who have a large portfolio and already kind of like managing and syndicating and doing all that stuff. But, as we chatted about last week, the key is someone who is looking to build a portfolio in real estate.
Right. Actively, like they're active, not somebody who's just looking to make $25,000 investments in 20 different syndications. This is your avatar, client's avatar is somebody who wants to actively purchase, own and manage properties. Is that right? Is that fair?
We do have a lot of clients who are business owners who are looking to grow their real estate. So not everybody is a full-time investor, but it is someone, so we have a lot of clients who are physicians that, have a lot of income from their medical practice. They also invest passively in other medical practices. So for those types of people, yeah, even if they have just, a couple of passive investments, there are really great ways to save on taxes as well, even though they are not actively involved. But I think it's difficult for the investor to really know, like, am I a good fit? Because we get into all the intricacies of it. And that's why, we have a free consultation for anyone who comes to us. Our team is really good at honing in on, whether we can help somebody, right? Because a lot of times it's hard for the investor to know whether or not they can be helped.
You know what is the most important thing is to at least recognize that you probably need help. That's the key.
It sounds like an AA meeting.
It's just like therapy.
But it is so important. You've got to acknowledge
that's good. You've taken the first step. That's good.
Take the first step, then you make the call. You'll find out more from Amanda Han, Matt McFarland at Keystone CPA. Thank you so very much for joining me on the show today.
Yeah, thanks for having us, Adam. This is fun.
Thanks, Adam.
All right, that was Amanda Han and Matt McFarland of Keystone CPA talking about 1031 exchanges. Oh my goodness, I do hope you made it all the way to here. That way you definitely heard some really big mistakes that people do make that Amanda and Matt talked about. You don't want to be making the same mistakes. Right. Amanda, Matt, thank you so much for joining me. What a pleasure meeting you. Thanks so much for going through 1031 exchanges. It is an interesting topic, and we got a lot involved, a lot into that hour. I can't believe it took an hour when we were recording it. It just seemed to fly, the time, actually. Anyways, largely thanks to your insights and responses to my varied myriad questions. And thank you too, dear viewers, for joining us today. If you want to reach Amanda and Matt, just go to the podcast page at gowercrowd.com, where you will find links to their website, their LinkedIn profiles, and a subscribe button to the Gower Crowd newsletter. Be sure, if you've not already signed up for that, that you do so without the delay. All right, that's it. Thanks so much for joining me, everybody, this week. Really appreciate it. And I look forward to seeing you next time. Until then, this is Adam Gower signing off.